if you have a whole lot of cash sitting on the sidelines, traditionally it's not working that hard for you. With uncertainties ahead in the markets this year, such as the direction of Fed monetary policy, we ask, what should you do with your money today? We're going to break it all down for you right here on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for joining us. I'm here with my colleague, Jerome Schneider from PIMCO, to talk about where we could be putting our money to work. Jerome, good to have you here in the studio. So the question keeps coming up. Obviously, we're looking at a lot that might be coming up this year, especially with new direction of monetary policy. Most economists expect the Fed will hold steady and maybe even towards the end of the year start cutting rates. So it means maybe the end of QT, quantitative tightening for investors. So how do you anticipate maybe how those short-term strategies are going to perform, especially as we look at a different Fed this year?
Yeah, without a doubt, it's at the top of mind for many investors, many advisors going forward. We've reached a pinnacle of money market fund assets over the past few weeks, hovering over $6 trillion now. That's a lot of money on the sideline, but there's good reason for it. And we would admit that investors really over 2023 and over the past few weeks to start this year have really been anointed with a tremendous amount of income simply because of front-end rates being higher than longer-end rates. The inversion of the yield curve has really created not only a defensive mechanism for investors to stay conservative, but also has rewarded them at the same time. But that platform isn't necessarily going to be as comprehensive, nor as necessarily the right answer to a comprehensive allocation strategy over the course of 2024. And so really to evaluate that, you need to bring together the various constructs of how investments and investment allocations will work. Monetary policy certainly sort of a part of that. Fiscal policy, the election coming into focus, that's definitely a part of it. And also what we've witnessed over the past few years is event risk. Really, where we want to take risk within known factors, how we think about allocations, and then recognize the fact that the world is a little bit more uncertain place at this point in time, and recognize that risk-seeking assets could actually be influenced at some point in time by some of those uncertain events that we don't necessarily know how to calculate or hedge, as we would say in portfolio management terms.
Right, yeah, like if we use the lingo that you guys are using when you're sitting on the desks. But it's interesting because we've seen this rise in money market funds in the last 20 years, a substantial increase from, say, 2003 to today. I mean, a lot of that is obviously the rate environment has been fairly strong, but also like you're talking about a lot of uncertainty out there, and we know the markets love certainty, and when there's uncertainty, whether it's geopolitical risks or obviously, you know, the last couple of years with monetary policy, it seems like people kind of wanted a safe bet, but that's not the best way to utilize that cash. I mean, for most investors, right. I should say.
And there is a rational experience in 2023 that suggests that people wanted to be at the front of the yield curve. For the first time in a long time, yields were attractive, it produced income, and more importantly, did so in a safe measure. But what's important as we go into 2024 is realizing that this idle cash isn't necessarily ideal cash. And from that prospect, what it really means is begin to sequence and think about your fixed income allocations in totality. The first step is rationalize that many people are coming into their allocations within their broader portfolios with an underweight to fixed income. And that's really has to do with the mechanisms to get people to fixed income over the past 20 years have been really driven by total return, capital appreciation, things that sought risk. But at the same time, the notion of earning income from fixed income was relatively small. Rates were low and even negative in some parts of the world, so it wasn't that great. So the initial indication of putting that cash to work, going from idle to ideal, is really something one that focuses on the facet that there is income to be had, but more importantly, now that we're reaching the crescendo of the rate hiking cycle of the Federal Reserve, investors shouldn't become complacent. In fact, they should begin to think about that world as the Federal Reserve springs into action and begins adopting a much more dovish policy over the course of the next few quarters. Now, when it will happen isn't necessarily as crystal clear as people suspect in the market, but we think that investors should begin to think at this point in time about moving out of that immediate cash money market type of strategy and figuring out how to adopt to the changing landscape.
Well, how do some of those fixed income portfolios that you're looking at and you're managing and our clients have in their portfolios, how are they sort of comparing what you can see to CDs and money markets and even short-term Treasury bills?
Well, the fascinating to myself, to my team as a practitioner at PIMCO, is recognizing the fact that it's a very bifurcated landscape for these conservative investments.
Right.
As an example, Treasury bills trade rich, meaning at a lower yield than even the federal funds benchmark rates that the Federal Reserve established. Consequently, money market funds actually trade lower at a lower yield, lower return than those benchmarks as well. But you also see the landscape as being very undulating with regard to other high quality asset classes. In many cases, certificates of deposit, which have a certain amount of illiquidity to them, can actually trade at lower yields than money market funds. And even certificates of commercial paper can do the same thing as well. So the landscape for demand deposits, certificates of deposits, money market funds is something that's very bifurcated and can offer varying degrees of return. However, what we want to think about is recognize the fact that by moving slightly out the yield curve, you might actually find yourself in a very useful triumvirate of balance, which is capital preservation, liquidity management, and also some total returns, which help protect you and produce returns as the Fed begins to ease during the cycle over the next few quarters.
Right. Yeah, I know you, I'm sure, and everybody that works on your team and all of us here at UBS, particularly our CIO, are really looking at every single period, comma, dotted I and crossed T that the Fed says, whether it's the minutes or it's the statement. So we're looking to see if we can get any kind of color on exactly when the rates will begin to decline or when they're going to start cutting rates. But interestingly, you talked about CDs, and obviously there are a lot of reasons why people may want to stay in cash. They may be buying a second home or a first home. They want to save the cash for that. They may be funding a child's education. But on the flip side, there's billions of dollars coming due in CDs this year. So for those that are still in CDs, what are some of the challenges or implications of that for them?
Well, first and foremost, I think one of the key factors is recognizing that as we get further along into this economic cycle, there is some uncertainty to it. We find a lower growth pattern, which is going to be somewhere between 0 and 1%. There is a tail risk of a recession, but it's not a hard landing that we would see. So call it a soft-ish landing that we're going to have to adapt to.
We've been calling it a softish landing here as well, so it makes sense.
And I think that from that perspective, you need to create a balanced approach to understand that. The second thing, and you sort of alluded to this a moment ago, is that the timing of exactly when the Fed cuts or the Fed cutting cycle begins or how it progresses is actually a little bit challenged. And I would say that it's really much more data dependent than people suspect. So you're going to ask, if we don't have a crystal ball and you don't have a crystal ball, how to adapt to it. So we want to think about making adjustments to portfolios and moving out the cash that favors a structural advantage, higher yields, higher returns, than simply sitting in that cash. Let me explain. When we think about being in money market strategies at this point in time, we think of it as a rate that you're earning based upon the current Fed funds rate. And that rate will adjust to whatever the Federal Reserve chooses to do, almost instantaneously. So as the Federal Reserve comes down in rates, if it's March, if it's May, if it's June, or if it's even to next December, it will adjust instantaneously. So your returns, even though you expect them to be around 5% today, are unlikely going to be cumulatively 5% over the course of the next year in terms of your total return. So those are headed lower undoubtedly unless the Fed somehow reason stays on hold. However, one of the ways to think about it is don't necessarily wed yourself to betting on the Fed. Think about ways that you can earn these structural premiums by having some high quality spread products, and more importantly, find ways that help adapt the portfolio to earn higher income for longer. So that entails earning just beyond the money market space, perhaps having a little bit more interest rate duration, not a lot, but well within that 0 to 1 year space that allows you to extend, and more importantly, gives you a great diving board, a great platform to jump off into further fixed income allocations as we get more clarity in terms of where the evolution of the economic cycle is headed. So for those who are really conservative and uncertain, there is a much more structural opportunity to continue to earn the high yields at the front end of the yield curve than being in a money market fund.
That's great, Jerome. Yeah, and it sounds like what you're saying is what we hear all are saying is look for quality when it comes to investing within the fixed income landscape, and that's exactly what you're saying here too. So given that, and obviously people who are watching this may be then calling their financial advisors afterward and saying, I listened to this conversation, I'm interested in talking more about it. What would you say or suggest to those investors out there who are looking to be getting out of cash, going into a fixed income product? What should they be looking at right now?
So they need to think about diversification first and foremost. And that really gives themselves the ability to navigate liquidity from a holistic point of view and not be in any one asset class. Certificates of deposit are generally attractive, but they're also one type of asset class. So create yourself an opportunity to be more diversified in that approach. Secondly, remain high in quality. We're not suggesting going down in credit quality. Many of these type of short-term actively managed strategies remain AA minus type of average credit quality, that's perfectly fine. It allows you to be defensive and yet balanced over that term. And then third thing, which is most important, but actually the most direct and simplistic for advisors and end users to do, is really rationalize the amount of cash they need in real same-day liquidity strategies. Owning T-bills and money market funds are good purposes for that, but generally what we're finding is people have 10, 15, even more, 10 or 15% or even more sitting in these money market fund strategies when they only may need 1 or 2%. So earn your liquidity premiums by taking the next step out to what we call tier 2 cash and rationalize that you really don't need that much cash sitting in money market funds, certificates of deposit, and most importantly, as the environment changes, both from a relative value point of view as well as an opportunity point of view in terms of the economic cycle, it allows you to pivot. You can use these strategies as a place to move into longer duration assets, if you like, into more specialized assets that we find attractive at PIMCO, like mortgages or tips. Those are avenues that we do like. And at the same time, it allows you the flexibility that should you actually find yourself in a more uncertain situation, geopolitical or a hard landing situation, you're still high in quality in that regard. And given the interest rate exposure, you're going to outperform what you basically find you should outperform what you basically find in a typical money market fund over time and over a cycle by earning those additional premiums.
Perfect, Jerome. Thank you very much. Good to have you here. I'm sorry we're out of time. It feels like we could talk more about this, but great insights from Jerome Schneider from PIMCO. Good to see you.
Thank you.
Thank you. And look, there's a lot of situations that you might be in that are different than your neighbor. So make sure you're having conversations with your financial advisor to make sure that what we're talking about today is appropriate and right for your portfolio and, of course, your investment needs. And make sure to check out our website, ubs.com/views, from more from our great partners like PIMCO and our own Chief Investment Office right here at UBS. Plus, you can follow us on all the social media channels. Instagram especially, at UBS Trending, is our UBS Studios channel where you can find content that you're not going to find anywhere else. In the meantime, from New York, I'm Anthony Pastore. Have a great day, everybody. And remember to keep your eyes on what's trending. We'll see you soon.